All right, this is Mike Doyle with the mortgage firm. We are here every Wednesday at noon to discuss any mortgage related questions you might have. And as always, I've got Elizabeth Lopez sitting next to me. And as you know, the greatest bank manager of all time. And she has joined us, and she's just absolutely killing it in the mortgage department. And Tom Bennick, he has been doing this longer than me, I believe, over 20 years. We work together in the banks. Tom is old school customer service. He will meet you at the house. He'll meet you at your business. He'll go to the bank. He'll pick up the statements for you. Tom will do it all. He'll sit down at closing, help you fill everything out. So Tom is truly, he does it all. So we've got a great group. We've been working together for many years together. And every Wednesday we show up and, we cover some topics and we answer your questions. Today, though, we're going to cover a little bit of alternative financing. And actually, Tom and Elizabeth are the experts on alternative financing options. So we'll run through a few things with them today.
Alternative financing is financing that doesn't normally fit the regular guidelines of Fannie Mae, Freddie Mac, the two agencies typically, and a couple of others that set the guidelines for loans, which would typically require income documents, 2 years tax returns or W-2s, bank statements, things like that. So those are what we call agency loans or loans that, of course, Fannie Mae, Freddie Mac, which we consider the agency, will accept. Not everybody qualifies for those types of agency loans. So there are called alternative loans, loans that are different than the agency loans. And that's what we're going to kind of cover today.
And even with the alternative financing, every single type of loan that we could do through them. I'm sorry, I'm going to be muting because I'm going to be coughing the whole time. But even with these, there are some requirements and certain things that we look at. Maybe like the income documentation may be slightly different, but then they'll last for like different percentages down. The interest rates look a little bit different. So we'll talk about all that too.
All right, let's pull some stuff in here. We'll go through a little bit.
Sorry.
Now, Tom, have you done a bank statement loan recently?
Yes, over the past 6 months or so, yes.
All right, because we've done a couple of them. We did one, I think, about a month ago, and we're in the process of working on two others right now. But a bank statement loan is for people that are self-employed. A lot of times, the way your self-employment stuff works is your income's not always shown on the tax returns in ways that we need to be able to count it. So, especially if you're doing stuff with capital gains or different types of assets that you're selling, or depending on how your accountants write everything off. So if you have the income and it's there, we'll look at your deposits. So we'll take either 12 months or 24 months of deposits. If we can do 24 months of deposits, it'll get you slightly better terms. But in general, we'll take your average deposits over a certain amount of time, 12 months or 24 months. And it's for self-employed individuals, not W-2 individuals. But if you're averaging $20,000 of deposits, we will go ahead and take about $10,000 of income, plus or minus, after we run it through, the investor formulas. So we can take that income and we can count that as your income toward buying a place. Now, if you have a type of business that's very service related, so you might not have a whole lot of overhead, we can go ahead and we can pull your CPA in to go ahead and do a profit and loss statement for you and show that maybe 50% is not expenses, but only 25% is. Then we can use a little bit more of your deposits and count that as income. So it's an excellent program and allows self-employed individuals to go ahead and be able to purchase houses, that are more representative of the lifestyle that they lead. So it's something that's very popular, and again, for self-employed individuals, it's a really good tool.
Yeah, the other thing is also with the bank statement loans. I know you say business and personal, but this past week I had two different scenarios. One of them I received personal statements, and the other one was business. The personal statements, just so everybody knows, like they go through all those deposits with a fine-tooth comb to make sure that what's going in there is specifically for the business and not and not something that just doesn't have anything to do with the business. So I mean, you got to be a little bit careful because like I did get notification that if the personal bank statement is commingled with business and personal, it some of the deposits in there do get backed out. So don't assume that every single deposit that goes in there is going to be accounted for. I guess they have their way of doing it, you know, and when we do the calculation for the bank statements, figuring out what deposits we're going to go ahead and accept or not.
That's a great point because you're right. We'll be looking at deposits, but you might be depositing money from a different account. So if you've got $10,000 going in from, receipts of sales to customers, but you're also depositing $10,000 from another business account, we're not taking those $10,000 from other business accounts. So it can't be money that you moved out then moved back in. So a lot of times, self-employed, they might have 3-4 different businesses or 4 different accounts, and trying to track the money and what are the true deposits from the sales in their business versus money moving around. A lot of times it'll be seen a lot differently by our customers than it will be by the investors or our underwriters. So we just need to make sure that everybody sees what we're looking for as actual business receipts.
Mm-hmm.
And keep in mind, these investors are the ones that are combing through your statements. We're not going through them. We have to upload those. You'll send those to us, and we upload those to the investor. So they're the ones that give us the feedback or give us the answers once they go through and decide which deposits they can use as income.
So Tom's saying is don't beat us up if the numbers don't come back the way you want. It's that other guy.
I'd love all of you to make $100,000 a month, but it doesn't always work out that way.
Yeah. And they do have they're very specific, and when we get the reports back, we'll know exactly what they mean by commingled, and if there's things on there, and it's very specific on the personal. I would just say if you could possibly get a business account, going with business statements, that's usually probably the best way to go.
Yeah, it's a great thing. I mean, as far as, because sometimes you might have had a downtime or something happened, you might have had a couple months that were bad the previous year. The numbers just aren't there. So, but you need to buy the house. So you buy the house, and then when your next set of tax returns come around a year later, then you go ahead and you refinance into something better. And it's actually now's a pretty good time because everybody's going to be refinancing anyways in the next 18 to 24 months. For the most part, we project that there's going to be people refinancing out. So if you're doing the bank statement loans right now, by the time you get your tax returns done, next time maybe you're showing more money, you can qualify for a more traditional type jumbo loan. The rate should be hopefully in a better situation than they are right now. Mm-hmm. Hopefully.
And while we're touching on rate with some of these programs, and these are called alternative financing programs because the borrower has to provide alternative documentation than what regular Fannie Mae and Freddie Mac wants. And that being said, the interest rates on these might be a little bit higher, or the cost might be a little bit higher on these rates. But these programs, I call it, are for people that get it. They're self-employed. They understand how the business works. These are great opportunity loans. So yes, even though there might be a little bit more of a cost to these loans, they're great opportunities for self-employed people. Which, speaking of getting it, I'm going to lead into the other one, which is the debt service coverage ratio loan.
This is your loan, Tom. You've done these.
These are good loans, for investors, again, that get it. And duplexes, triplexes, 4 units have been hard to find. There's more of them now that are hitting the market. This is great for an investor that wants to purchase an investment property. These are no income is put on these applications. What's determined with these purchases are the rent that is anticipated to be collected versus what the cost of the property is to carry every month. So on line 1, it says rental income. The PITI stands for the principal and interest, the taxes and the insurance, and any HOA fees. You total that number, and then you divide that number into the cost of what you're getting for rent. So rent always comes first. Rent first, and then the cost of what it is to carry the property. That number you want to be at 1% or greater. And that's the qualifier as far as qualifying for that loan. And if it is under 1%, there's still the ability to qualify, even though your loan to value might be, instead of 75%, it might go to 70. But credit scores go down to 660 on these. The only thing you really need to verify is, again, your credit score, your assets, and the rent. It's a great program for investors who get it.
Yeah, that's really good. Like Tom says, for an example, if you're renting a place out for $2,000 a month and your costs are 1,000 a month, your number is going to be two. So you're not going to find that, but that's beautiful. You find that, you jump all over that. But the 1.1 we're looking at is basically if you rent something out for 1,200 a month and your costs are $1,000, that gives you the 1.2, and that's a good number. Now, what Tom's even saying is, if you're running it out for $900 a month and your costs are $1,000 a month, now your number is 0.9. That's below one. We can still do it. And I think, Tom, the one you just did recently was the customer just had to put a little bit more money down. And was there an adjustment to the rate also, or just a bigger down payment?
No adjustment to the rate. The only thing she had to do was put down an additional 5%, which she was fine with doing because what her plan is she is going to purchase and close on the property. The current people that are renting are going to be vacated, and she's going to redo the whole property and rent it for even more than what it's renting for now. So she was fine with putting down the additional 5% because her overall investment is going to be well worth it.
Now, were they going off of the existing rent, or were they going off of the projected market rent with the place before it was renovated?
Okay, so they had to go off of because the property was currently occupied. It's a 2-unit, so both units were occupied. They had to go off of what the current rent is now that they're paying.
Okay, so that's what they did recognize. They recognized that it looks like it was probably below market rent. So, I mean, you would imagine an investor is not excited about lending you something that's going to cost you $1,000 a month, and you're only pulling in 900. But it does show, though, that we're under market rent. By the time she renovates the place, it looks like it's going to be a good investment.
And
These are great for people that are renters. We have people that own 10, 15, 20 plus properties. And generally, when we get those tax returns and we're looking at 20 different properties on tax returns, they're not something you can often extract money from. So it's just not there. But these DSCR loans are for that exact same reason, is that somebody who is in the business of renting properties can go ahead and buy a house with a good cash flow, and we're not looking at the income from the tax returns to qualify them.
Yes, I like this one. This is a good loan. It's a good loan for people that get it, again, that want to build. She wants to build her portfolio. She understands the bigger picture in the long run, and she's completely on board with it. A couple of customers are, so it's great.
Gotcha.
Big fan.
Excellent. Hey, Elizabeth, let's have you do the no social security number. Let's have you jump out to that one, the ITIN.
Yeah, we've been getting a lot of inquiries on the ITIN or the ITIN number only, which means that these are loans for people that do not have social security numbers. So when we do these, they're very specific on the biggest hurdle that I honestly think I find on here is that putting that minimum or the maximum amount that we're allowed to finance is 75%. So if they do ask for a 25% down plus. So minimum score is a 680. There is a minimum loan amount. We do have a maximum loan amount of 2.5 million. And they're only for one unit, so full documentation. So you do get asked for full docs. So W-2s, tax returns, everything. So we ask for everything on there. But again, I think those are the biggest two hurdles that's a little bit difficult. So full documentation, 75, but we do the ITIN number as well. I wanted to add to this one also. So we do have another one. This isn't really alternative financing, but just throwing it out there because if you have if you're under DACA, as long as you have your social, I think you're given like a social or like a tax ID number, not necessarily an ITIN. Those are two different things. If you have that, we are able to do just a regular financing for you. So that's something to keep in mind. But the ITIN, just let us know. Just let us know what you have, and then we'll kind of take it from there. But we do them.
Now, Elizabeth, explain like the ITIN, like who would have ITIN? Explain about the DACA program.
So an ITIN, it's somebody that doesn't have a social security number. So it may be somebody that's in the process of I guess getting a social, but you're still able to do your taxes. You may have like a work permit. So that's pretty much what you're looking at. DACA, the only difference from what I understand, because I am working with an attorney right now that has quite a few DACA cases, And I was able to explain to them that they are given pretty much a Social Security protected by DACA. So all the difference that they have is they have their Social Security, but they have an actual card, I guess, or how they're protected, I guess, through the program DACA. So they're able to do a regular loan that way if they have the DACA. If not, we cannot do it. And then that's when the ITIN would pretty much fall in. So I know it's more like immigration stuff. I met up with an immigration law attorney and gave me an earful on how that works, which was pretty neat. And we wanted to do, hopefully it's coming out soon, but we're going to do a video and just explaining how we could do these DACA loans and all that stuff. But that was just in addition to that, because I know that the DACA with the social gets a little bit confused with the ITIN number. And this one does work a little bit different.
Excellent. Elizabeth is actually going to start doing a home buyer class that we're looking at most likely first Tuesday of the month starting in April. So she'll be doing it in Spanish, and she'll be covering down payment assistance programs that are out there, along with some of these other programs that we could be running into also. Mm-hmm. All right. Let's go back. Annuitizing assets. One of the things that can be frustrating to customers is, maybe they just moved down here and they don't have a job. They want to buy a place, and we can't get them financed. But if you have money, someone says they got $1 million and they want a $250,000 loan, how come they can't get a $250,000 loan? And we do have the ability to start annuitizing assets. So if you're 59 and a half and you have retirement accounts, IRAs, 401, stuff like that, it's very easy. If you're not 59 and a half and you're younger, but you're heavily, you have plenty of assets, we can go ahead and take those. Now, depending on the program, we can at least divide them by usually 240. So if you got $240,000 in assets and investments, we can turn that into $1,000 a month. Somebody who's got, $1 million, we can turn it into a little bit over $4,000 a month, which isn't a ton. But you also have some other types of programs where we have the ability to divide it more by 120. Now, we have customers, though, you can put these in different types of investment products that will give you a 5-year payout. So somebody who's got, $100,000, they can put it in 5-year payout programs and create potentially $20,000 a year of income. So there's different things we can do that to help people generate, secure income that we can use to help them afford properties. Now, if they're 59 and a half, though, we take that IRA or that 401 and we can go ahead and annuitize that. So basically, if you have $360,000 in an IRA or a 401, you could draw $10,000 a month of income out of that for the next 3 years. So if you have 3 years left in there, you can start drawing $10,000 a month. And if we see one distribution of $10,000, we can count that as your income, as long as we can see 3 more years. Now, technically, what I would want to do is I'd want to see $370,000 in case there was a delay in the loan, and we ended up closing basically a month later. But it's a great product. If somebody does do that and they start annuitizing an IRA or they annuitize some type of money, we want to see that at the end of 5 years, when that money could potentially be gone, what's the plan? Because that's something that'll sometimes maybe happen at the end of a divorce settlement. Somebody gets a lump sum of $200,000. They put it into some type of product that just pays out over the next 5 years. But we want to show, if you're going to be in the house for 10, 20 years, what's your plan? So I had one not too long ago where it was a woman was finishing up her teaching degree. So her goal was that she would finish up her teaching degree and then she would be a full-time teacher and she would have the money that she needs to be able to go and make her payments. So the biggest thing we want to make sure, though, is even though the program is out there, we want to see, does the program fit the person's needs? And are we helping the person out or are we hurting the person? And the biggest thing is, by having an honest conversation with the customer, we can decide that, because our goal, and I had this conversation with a customer today, our goal is we want to take care of everybody. We've been doing this for a long time. We want everybody happy at closing. because there is no loan that we need that's worth messing with a reputation that you've earned over your career.
Yeah, it's the opportunity to have loan products that are available to, whether you want to go with the Fannie Mae, the Freddie Mac agency ones, or you don't follow those guidelines and you want to use an alternative financing program or bond loan program. So again, we just always ask, if you're considering, even if you're looking to purchase something 3 months, 4 months, 5 months down the road, reach out to us, get things at least started, get credit started, get options started, and get a conversation started is the best way.
Yeah, Mike is so right on that. Earlier today, it's funny, you want to make sure that we're doing the right thing for our borrowers, and we've talked about this so many times, putting them in the right excuse me, loans. And we had an email just congratulating our office, because I think we just had a loan that canceled. Long story short, it was nothing that we did. It was polybutylene pipes, and God knows those are tough. But the borrower was just so, even though we couldn't get that closed, they were just so happy to say, you know what, thank you so much for your honest opinion, for just being honest with me, that what I can do, what I can't do. And today he's putting in another offer in another property. And again, it wasn't something that we did. He was just so appreciative of us being able to just tell him this is what we have going on with the loan. And again, just being transparent and honest. And I think a lot of these loans, you may think, oh, this is a good fit for me, or I could do this. It's like Tom said at the beginning, sometimes it's the rate, sometimes it could be the down payment. If it fits for you, it fits for you. And if not, then we'll figure something out. But this isn't a one size fits all, kind of thing.
Yeah, these are, it's like fingerprints. Everybody's got a different situation, a different scenario, different income, different assets, different employment, but they can verify what they can. So it's us getting to know what that situation is and what your employment and such is, and then putting in the right loan program.
Mm-hmm. Yep.
All right, and just for fun, let's take a look at and talk a little bit about
okay.
rates.
Oh, no, we don't talk about fun anything. So, what's he bringing up, Tom? Like that, Mike.
So the rates are actually, let's get in here.
2 o'clock, the Fed, I think, is meeting. So we'll see if they're going to raise them or make any adjustments. There's obviously the 10-year, but go ahead, Mike. I'll let you kind of break it down. You're much better.
And
he's not a numbers guy or anything.
You're much better at it than I am.
Well, the thing though is, you're right. The Feds they're talking about whether they're going to raise the rates, and again, I backed off on pushing that, but the fact that they're raising the short-term rates is, in theory, should be helping the long-term rates, because it's the goal that it's getting inflation under control, but it just hasn't been always that exact correlation. But you can see over the last month, we have had a nice little drop in the rates. So the rates were trickling down, and then you started having all these banks having their issues. So the banks started having the issues, and that created some uncertainty out there, which brought the 10-year down, because people were starting to pull their money out of the banks. When they pull their money out of the banks, they start buying bonds, and then it really runs the price of the bonds up, which lowers the yield amount. So if people are buying bonds, the yield starts becoming less, and the long-term rates become lower. So, it's been slowly creeping up a little bit, and for whatever reason today, it's come back down a little. So that the key is going to be, it's not so much what they do today at 2, it's the reaction of the markets. Do people think that what they did is helping inflation and long-term, or is it hurting inflation? So it's not so much the raising of it or the lowering of it, or whatever they're doing, whether they raise it a quarter or a half. It is expected they're going to raise a little, but it's what the perception of what they've done is going to affect our economy. So we'll sort of see from there. But look, if we could hang out, like when we're down around 3.3, we're in the low 3s. It seems to make a big difference. If we could start dropping a little bit below 3 on the 10-year, and we start getting our rates, into the 5s on a more regular basis, then it I think that's probably our numbers that start making more sense to people. So nobody likes to see, rates in the sevens and above.
Well, the 10-year was headed towards 4 until, if you kind of break down this chart, you could see that like it was kind of, and then you have a big drop. Well, I look at it as, okay, bank failure 1 drop, because that's when that happened.
Yeah, right. There was the bank failure.
Bank failure 2, another drop. Bank failure 3, and now we're going back up a little bit. So the banking industry, I think, in this case, is the one that really, put a peak on climbing rates. So let's see what happens today. But yeah,
I was telling everybody that but all the stuff is that we were projecting the rates were going to be dropping towards the middle of March. So it looked like they were dropping towards the middle of March, and it seemed to be, happening. Like I think we came in with some decent drops, but then when the banks started failing, I couldn't take credit for that. So those bank failures kind of came out of the blue. I mean, I'll take the full credit for kind of predicting that they were going to drop a little bit there, but that just sort of came out of the blue. Now, I think they're starting to get, it's probably recovering a little bit more to where we were projecting it to be outside of the bank failures,
right?
Because it looks like people are believing that we're not going to have a run on the banks, So, but there was some uncertainty there as we were looking at a couple of big banks that were running into some problems. Were we looking at a big run on banks, and how was that going to affect the markets overall? So people seem to have gotten a little bit more comfortable with that recently. So
yeah, the smaller regional banks were the ones that were kind of getting hit with that, regretfully. But yeah, hopefully it's under control. So we'll see what happens.
Yeah. Now, I will see though, in our industry, we are seeing a lot more positives. We're getting a lot of calls. We're getting a lot of people that are just getting off the sidelines. And it comes back to how long can you put your life on hold? I'm working with some retired couples right now, and again, your time is as you become older, and Elizabeth, being just a young kid, doesn't understand it, but the appreciation for time and the reduced time that you have, it becomes very important. So, as you get older, I run into people that are like, you want to be around your family. You want to be in the areas you want to be in. You want to be, spend your time, in the areas where you want to spend your time. So if your kids end up with a couple $1,000s less, at your funeral, that's fine. And I always tell people, in my house, you get a bill. When somebody dies, you get a big fat bill. So, I definitely want to make sure that, I spend my time, in a way that's enjoyable for me. And we're seeing a lot of that. And also too, if you're young families and you're raising families, you want your kids in that certain area, you want that kids home, and people are realizing that, all right, I'm going to buy with the understanding that they will be refinancing sometime in the next year and a half, 2 years, hopefully.
Well, we've said this before too, like may not be your forever home. I have a couple that currently under contract, closing beginning of April, and their rent is just absolutely outrageous, but they have a little one. They have a 6-month-old. And what they did was they are purchasing a townhouse. So for them, it's almost like before going into their dream house, which is going to be later on, they said, you know what, let's do a townhouse. And later on, it can be maybe just, rental income in the future, or, or whatever, but they just needed to have a little bit more space. It didn't need to be, their dream house right this minute, but I think people are realizing that, hey, you know what, I need to move, whether it's rent going up or, for them, or the landlord also, with the sale of their properties, that's still happening. So, they were able to find a really, really pretty remodeled townhouse. And it's almost like a little step, just a stepping stone for them in order to have what they're going to have in the future. So, this market actually just kind of makes you think a little bit more about that.
That's a great point. As far as getting a starter house, I've got somebody as well was going to put everything on hold and rent. Excuse me. Don't you realize that in order to even qualify for a rental now, they're going to check your income, and I believe you've got to make at least 30% or $9,000 a month to pay $3,000 a month in rent, and even their guidelines are stricter than ours. So it's because I'm going back to look for a property because the guideline in order to get into a rental is ridiculous. And then first, last, security. She's got a pet, and it's tough out there on the rental market as well.
And even, what I love, what the first class and security, just right there, it's if you qualify for a bond, that may be something that comes into play. You have your first lesson security already there. A bond may put you at the point where you will be able to purchase a home instead of renting. So check in with us. Don't assume that you can't do it, or excuse me, man, Tom, whatever you and I have, I don't know what it is. We keep
Don't
clearing
cough
it.
this way.
I know. Like, I'm staying home. But your first lesson deposit, like I said, you just never know what you qualify for. And let us check your credit. We'll do a soft pull just to see where where you stand with your credit. We'll at least be able to check that out. And yeah.
I want to touch on that real quick with the soft pull. That's something important. Everybody's always concerned with, marks on my credit. We now have the opportunity to do a soft pull on your credit report. Correct, guys? Just
Yep, absolutely. We're doing all soft
not
pulls.
affect your credit score at all. Again, another reason to reach out to us just to get the conversation started. Because if you don't want your credit pulled a million times, it won't even show up.
And also the beauty is that they're not selling the soft pulls.
Mm-hmm.
So it's not like, we had somebody say they had 50 calls after a hard pull. So what we do is we have some opt-out opportunities. We can send you some links. You go through and you opt out of the phone solicitors, and while we do the soft pull. So we do a soft pull. It lets us take a look at your credit, see where you are. We can run some credit analyzers. There's a lot of things we can look at with the soft credit pulls. On certain types of loans, we absolutely need that hard credit pull, and we need to do the hard credit pull prior to submitting the docs out to you for signatures. But yeah, that soft credit pull is absolutely huge.
Mm-hmm.
I'm loving it. I think a lot of my clients are loving it too, just to know where they stand. And like you said, the fact that we can do, we can run Wayfinder to see how we could get credit improved. We could still give those options if there's something very small that they got to work on. And pretty much at the point, we get everything, we'll ask for documentation, we'll ask for everything up front, because once again, we want to have the file ready to go. And then the moment that you do have a contract, we'll do the hard pull, and we'll have everything just ready to roll with it. But at least we have all that information in place already. I love it. Like, and I know all my clients right now are loving that too, especially now receiving the solicitation calls.
Yeah, back in the day when you used to have that call waiting, we'd go and be taking an application, and you'd pull the credit, and you're still on the phone with the customer, and you could hear beep, beep, beep as everybody was buying credit. And you do have, we run into, when you come out of all the refinances that we had, in the last 2 years, you have a lot of big companies out there that the majority of their business is refinance. And then they got a lot of money. They buy a lot of leads. So you have a lot of companies that are buying those leads. And unfortunately, they're getting sold. So when you get those hard credit pulls, it just seems it opens it up. Now, people have all these different ideas. Don't, put in phone numbers, don't put in emails, don't put in things like that when you pull credit. And they're way beyond that. They've got all the information. So, when you get a hard credit pull, a lot of people are getting your information. So,
all right, we're going on 33 minutes.
Jeez, let's go. That's because bank statement loans are just so exciting. Now we have a homebuyer class this evening. Every Wednesday we do a homebuyer class at 6:30. So hop into our Facebook Live. The mortgage firm of Wellington Lake Worth on Facebook. Pop into our Facebook Live at 6:30. You can always go to tmfclasses.com, sign up for a class. But every Wednesday at 6:30 we have the class. Every Wednesday at noon we do the question and answers. And again, we're going to start a mortgage basics in general for new realtors. Will be the first Monday of the month, and then we'll be doing a home buyer class for Spanish-speaking customers that Elizabeth will be, putting on the first Tuesday of every month. And when she's not there, Tom says that he will have Spanish down by May in case we need to call him. Right?
Me and Google.
We have our entire team is Spanish outside of Tom and I, unfortunately, but we've got Kathy and Deanna and Carolina and Elizabeth, all bilingual. So, anything else good, guys, before we go?
That's it. Go to our Facebook page. Please share, like, and thanks. We'll see you tonight.
All right, guys. Have a great week.
All right. Yeah.